Welcome back to Today Assets Report, the channel that cuts through the noise and gives you the forensic read on what's actually moving inside the financial system before the crowd figures it out. Today we are talking about XRP, but not the price, not the chart, not the red or green candle from yesterday morning. We are talking about something far more important than any of that, and honestly, something that most XRP holders have never paused long enough to understand. Here is the headline that should be living rent-free in your head right now. 5,000 XRP might be far more powerful than most holders realize. And I do not mean powerful in a motivational poster kind of way. I mean structurally powerful, mathematically powerful. The kind of powerful that only reveals itself when you stop watching the ticker and start reading the ledger. So, if you have been sitting on a few thousand tokens wondering if any of this still means anything, stay right here, because what comes next changes the way you see your position entirely. Let me set the stage for you before we get into the data, because context is everything in a market this noisy. Right now, the XRP price looks flat. It has looked flat for weeks. And if you are only watching the number on your screen, you are probably feeling one of two things, either frustrated or bored. Both of those feelings are completely understandable. But here is what those feelings are costing you: your ability to see what is actually happening beneath the surface. Because while that price sits perfectly still on your exchange app, the entire ownership structure of XRP is being quietly and deliberately rewritten. The people doing the rewriting are not retail investors refreshing their portfolios at midnight. They are institutional desks, asset managers, and regulated financial entities that move capital at a scale most of us will never experience personally. And they are not buying through your exchange. They never were. They walk through a completely different door, and understanding that door is the first step to understanding why 5,000 XRP is not just a number. It is a coordinate. Here is something that most financial channels will not say plainly, so I will. The price you see on Binance or Coinbase is not the price institutions are paying for XRP. It has never been that price. When a firm like Franklin Templeton or Bitwise needs to acquire hundreds of millions of dollars worth of any asset, crypto or otherwise, they do not open a standard account and start clicking buy like the rest of us. They go to an over-the-counter desk. OTC desks are private, off-exchange, and completely invisible to your chart. They source liquidity directly from large holders, from custodians, sometimes from Ripple's own strategic reserve, and they settle those trades entirely in the dark. No candle, no order book movement, no signal visible to retail until the position is already built. What this creates is a two-speed market. On one track, you have the retail price, the number most people are obsessing over every morning. On the other track, you have institutional acquisition, happening quietly, at scale, with zero obligation to show you what they are doing until it is already done. Now let us talk about the supply side of this equation, because this is where the math stops being abstract and becomes genuinely alarming if you understand what you are looking at. XRP has a fixed total supply of 100 billion tokens. That number is not changing. Of those, roughly 57 billion are currently in circulation. But here is the detail that should stop you mid-scroll. According to exchange reserve data from CryptoQuant and Glassnode, the total sellable supply sitting on centralized trading platforms right now has dropped to approximately 1.67 billion tokens. Let that number land for a second. 1.67 billion tokens available to buy across every major exchange on the planet. That is a 7-year historic floor. We have not seen liquid supply this thin since 2019. Before ETFs existed, before institutional custody infrastructure existed, before any of this was a regulated conversation. The shelf is nearly empty, and most people watching the price do not even know the shelf exists. So now pair that supply floor with what is happening on the demand side, and this is where the picture becomes something you genuinely cannot look away from. Total assets under management across XRP-linked institutional investment products have crossed $1.5 billion. Read that again. $1.5 billion in institutional demand pressing against a liquid float of 1.67 billion tokens. Those two numbers are not living in separate universes. They are on a direct collision course. And when $1.5 billion in managed, patient, long-horizon institutional demand begins seriously pressing against a token supply floor that is itself shrinking every single week, the exchange price stops being a real-time reflection of value. It becomes a lagging indicator. The institutions building positions beneath the surface do not want the price to move yet, not until they are done accumulating. The surface stays flat because the buyers need it flat. That is not conspiracy. That is how every major accumulation phase in financial history has worked. What makes this moment different from other XRP bull cases you may have heard before is the consistency of the institutional behavior we are seeing in 2026. Bitwise and Franklin Templeton have now recorded 55 consecutive days of net positive inflow into their XRP investment products. 55 days, no reversal, no interruption. In institutional portfolio management, that is not a trade. That is not a speculative position. That is infrastructure being built. You do not run 55 straight days of net inflow if you are looking for a quick exit on the next pump. You do that when you are laying the groundwork for a position designed to last not through the next candle cycle, but through the next decade of global financial infrastructure being rewired from the ground up. These are not people gambling. These are people building. And the difference between those two things is the difference between noise and signal. I want to point you toward one specific data point from earlier this year that I think is the clearest institutional signal this market has produced in over 2 years, and I do not want you to miss it. In February, during the broader crypto market correction, Bitcoin recorded $260 million in net outflows from institutional products in a single week. The big money was reducing Bitcoin exposure during the dip. Standard risk-off behavior, right? Now here is what XRP did during that same exact week. XRP captured $63 million in fresh institutional capital, not outflows, inflows. While Bitcoin's institutional holders were pulling back, XRP's institutional holders were accelerating. They treated the dip not as a danger signal but as a restocking opportunity. That divergence in the middle of a market-wide correction is not noise. That is the fingerprint of smart money that already knows something the chart has not announced yet. Let us go deeper into the on-chain data because the wallet-level picture adds another layer to this story that most analysts skip over because it requires more patience to explain than a 60-second short allows. Two things are happening simultaneously right now at the wallet level, and together they paint a picture that is almost impossible to misread. First, wallets holding under 1,000 XRP are leaving the active network at accelerating rates. The small retail holder, the person who bought a couple hundred tokens on a whim and forgot about it, is getting shaken out by weeks of flat price action. Their tokens are not disappearing, they are being absorbed. Second, and this is the critical number, accumulation class wallet addresses, defined as wallets that consistently add to their position regardless of short-term price movement, spiked by 51.5% following the recent dip. For every frustrated retail investor who sold into the flat market, a structurally patient buyer was on the other side of that trade, absorbing those tokens at a discount and moving them into cold storage. This is what distribution mechanics look like from the inside. When you combine the drain in exchange reserves with the spike in accumulation class wallet activity, the direction of flow becomes undeniable. Liquid supply is migrating from hot exchange wallets into cold storage, into institutional custody vaults, into ETF reserve structures, where it is locked, where it cannot return to the open market without a seller making a deliberate, coordinated decision to exit at a price dramatically above where we are today. And here is why that matters for your 5,000 tokens specifically. Once XRP enters a multi-signature institutional vault, it does not come back to the market for a 10% gain. It is gone from the liquid float, potentially for years. And as that faucet of available supply slows to a drip, even a modest buy order from a mid-sized institution becomes a high-pressure event hitting a near-empty exchange order book. The mechanics of a price move in that environment are completely different from anything this asset has experienced before. Now let us talk about the demand triggers that are scheduled to activate in the second half of 2026, because accumulation alone does not produce price movement. What produces price movement is the activation of demand that has no alternative, demand that is operational rather than speculative. The first trigger is RLUSD, Ripple's dollar-pegged stablecoin. This is not a speculative instrument. It is a settlement tool designed for high-velocity bank-to-bank transfers running across the XRP ledger. Every RLUSD transaction generates a fractional burn of XRP. Not as a fee in the traditional sense, but as the operational fuel that makes the rail function. When RLUSD adoption reaches critical mass across even a handful of major institutional payment corridors, that burn rate begins compounding daily across concurrent settlement flows, and the supply math we have been discussing stops being theoretical. It becomes a daily ledger reality that no amount of bearish sentiment can talk away. The second demand trigger is the bank charter wave, and this one carries a dynamic that is unlike anything speculative crypto has experienced before. Ripple's push toward federal banking infrastructure in 2026 is not a PR move. It is the foundation for what I would call a mandatory buy phase. When a regulated financial institution requires XRP to function as the bridge asset in their settlement architecture, they are not buying because they like the chart or because a YouTuber told them to. They are buying because the operational infrastructure demands it. That purchase is not discretionary. It is not emotional. It is a line item in a compliance-driven treasury operation. And that kind of demand, institutionally mandated, operationally necessary, and completely indifferent to retail sentiment, is the most powerful demand signal any asset can develop. We are watching the groundwork for exactly that being laid right now. The third demand pillar is the Fortune 500 exposure wave, and this one is broader than most people have processed. By 2026, approximately half of the world's largest corporations are expected to hold tokenized assets, or formalized digital asset strategies. When treasury allocation from legacy corporations begins flowing into digital asset infrastructure at scale, and the primary settlement rail for cross-border digital payments is the XRP ledger, the demand that follows does not require a catalyst event. It requires supply, and we have already established that the supply is running historically thin. These three demand pillars, RLUSD burn mechanics, bank charter operational mandates, and Fortune 500 treasury exposure, are not hypothetical futures. They are scheduled events with measurable progress already underway in 2026. The window to be positioned before that demand becomes mandatory is not infinite. It is closing, quietly, every single day. I want to address two concerns directly now because serious holders deserve honest answers and not just momentum-driven reassurance. The first is the escrow situation. Ripple still controls approximately 39 billion XRP tokens in a structured release of 1 billion per month. The legitimate worry is that if institutional demand does not scale fast enough, that supply hits the open market and creates a persistent ceiling on price appreciation. Here is the structural reality. Ripple has historically relocked the substantial majority of each monthly release back into new escrow tranches. The operational supply that actually enters circulation is a fraction of the headline figure. And as bank charters activate and RLUSD adoption scales, the demand side of that equation grows measurably faster than the release cadence. The escrow is a real risk. But it is a risk with a known schedule, a documented history of managed releases, and a demand-side counterweight that is growing in a way that is publicly verifiable. The second concern is what I would call the RLUSD velocity trap. If major banks ultimately stick to traditional payment rails or build their own private ledgers and RLUSD never achieves genuine settlement traction at scale, the bridge asset thesis weakens significantly. That concern is completely legitimate, and I will not wave it away. This is not a guaranteed outcome. Anyone presenting this as a risk-free investment is not an analyst. They are a salesperson. Investing in digital assets like XRP carries significant risk, including the possible loss of your principal investment. Nothing presented in this channel is financial advice, and you should always conduct your own thorough due diligence before making any financial decision. What separates a structurally informed holder from a speculative one is the ability to tell the difference between a risk that dismantles the thesis entirely and a risk that tests it. The RLUSD adoption timeline is a test. Ripple is no longer in a courtroom defending its right to exist. It is in boardrooms competing for share in a $4 trillion global payments industry. That shift, from legal survival to commercial execution, is the most important structural transition in this asset's history. And that brings us back to where we started, the number 5,000. With only 5.1 million active wallets globally, XRP is more concentrated, more structurally scarce on a per capita basis than almost any Tier 1 financial asset in modern history. The distribution thresholds on this ledger are not motivational targets. They are actual coordinates of financial positioning in a supply-constrained infrastructure asset. To sit in the top 10% of all XRP network participants globally, you need approximately 2,500 tokens. To reach the top 1%, that threshold sits around 50,000. 5,000 XRP places you squarely inside the top 10% of the entire network. A network whose liquid float is at a 7-year low and shrinking. As institutional lockup accelerates and the free float continues contracting, those thresholds do not stay where they are forever. The window to reach them at current prices, and while the room is still quiet, while the chart still looks boring, while the impatient are still walking away, that window is not permanent. The ledger does not record your sentiment. It does not record your hesitation. It only records who held, who sold, and who accumulated while the price was still flat. Stay anchored to the data. Stay with Today Assets Report, and we will be back with the next signal the moment it moves.